Well, let's break it down and start with the capital stack. On the buy side, no one has stepped away from the table, although there is understandably a heightened level of caution amongst buyers. Cap rates are diverging. The demand for super prime assets appears to be insatiable, and returns have dipped further in response to the scarcity of these assets and the cash flow security they provide. And this is very much a global phenomenon. Conversely, buyers are very discerning when it comes to assets with any sort of leasing or market risk attached to them. And in uncertain times, this divide only widens. Looking at pension funds, a recent BMO research report estimated that the average pension fund allocation to real estate was 12% versus a target allocation of 12.8%. Now that doesn't sound like much, but this represents an underallocation of approximately $4.5 billion. Now, given the paltry returns associated with fixed income, it seems likely that these allocations will, if anything, increase to ensure that plans remain adequately funded. At the same time, of course, there are few quality assets to buy, and the spot price of oil does not change that equation. REITs remain a very attractive asset class in a low interest rate environment, and as I am sure will be detailed later today, are in good shape regardless of the metric applied, whether it is AFFO spreads over 10-year Canadas, discount to NAVs, or discount to US REITs. Their cost of capital has been lowered, and we expect REITs will continue to be selective buyers in 2015. Private investors were the largest buyer profile in 2014. They remain nimble, tolerant of risk, and with financing at historically low levels, it seems unlikely that their appetite will diminish in the coming year. Cap rate spreads over 10-year Canada bond yields, which were already quite healthy, have widened dramatically. 10-year Canadas now stand at the lowest level in 60 years. The spreads reflect the uncertainty and perceived risk in the market and also suggest that there is a sizable cushion to absorb an increase in interest rates. Now, conventional wisdom was that rising interest rates were the greatest risk to the investment market. Well, it certainly appears that this threat is off the table, at least for the foreseeable future, and we may in fact see an extension of this bottom for some time, perhaps even years, with measured increases at worst. If rates do go up, it would likely be on the back of improved economic activity, which of course would boost fundamentals and net income. Now, the buyers that traditionally have been the most heavily geared to REITs, or to interest rates, are the REITs. And even if you do believe interest rates are going to go up, CIBC calculated the effect of refinancing all REIT debt maturing in 2015, 16, and 17 at 100 basis points higher than the rates as of mid-December 2014. Their conclusion was that the impact would reduce FFO, or funds from operations, by less than 1% per year. That is a pretty negligible impact. Debt is still readily available at historically low rates, with most lenders reporting unfulfilled allocations. Underwriting remains disciplined, particularly with regard to energy-based markets, and we are beginning to see the emergence of interest rate floors, which speaks to how incredibly low rates have fallen. So on the capital side of the ledger, things look very good. Attractive and abundant debt from disciplined lenders, and all buying groups active.